So we discussed question number 1 and 2, 25 marks each, 25 marks each. I would like to bring to your note chartered exam paper, this financial management. You might have followed classes or maybe on your own you must be studying. But one of the key thing the expected by the institute is to that you go through the study pack which is published by institute with the BPPA publication, right? So institute require you to go through the study pack. You need to go through that in detail. The simple reason because there are a lot of things you will see that it's very self-explanatory, right? Even if you are not following classes, you could still read and understand. A lot of good examples are given and then the explanatory notes are given. So the expectation of the institute is that you go through the study pack reasonably so that you are aware of all the concepts. It's not just passing the exam, that you gather the knowledge properly. If you are following classes even, still you are expected to go through the study pack, because the study pack has a lot of thing and lot of material which are very, very easy to understand. I would say, like, because mostly the people complain that study pack is not good, but this study pack is very good, very good. So you have to go through. Now you are people who are doing the exam in July, you are talking about another 1.5 months. Please go through each and every area what you have done wherever, or you are on your own if you are studying. Please go through the study pack each and every area so that you are clear about every aspect, because the examiner requires your knowledge, proper knowledge for your exam. It's not you just try to get the exam through on some manner. It's not that the objective. The second thing I would like to tell, some of the examiner comments. The examiner has been giving comments on the questions, how the students have approached. The first two questions are 25 marks each. So if you take this paper what we have discussed today, the question one basically which was talking about the chairman's view on the value maximization stuff. There the examiner expect you to discuss about what we discussed today, all the relevant aspects. Some people have ignored a long-term objective, short-term objective, you don't touch upon it, and value maximization of everybody, you should be talking about it. And you need to be very clear in your technical knowledge, right? So you need to know that there is a shareholder expect return. Based on the risk of the company, expect return. So you need to make sure that shareholder returns are looked after properly based on the risk he has taken. Because as I told you, shareholder is an entrepreneur who is the one who has started a business. So he wants return based on the risk what he has taken. So you need to ensure that that is given while giving importance to all other stakeholders. So these facts have to be disclosed or written in your answering. Then I am just touching up some of the examiner comments, right? Then you are talking about comparison of the NPV equivalent annual cost. There the students have not taken the equivalent annual cost consideration, even though your NPV had been used, NPV concepts have been used by many people, but then your comparison of two projects with different time period was not considered, 5 years, 7 years. So that has to be looked at. And when you are constructing cash flows, some people have not considered the tax benefits, tax benefit on expenses and lease installments, all that you are not considered. So please make sure that you are taking all the cash flows in your evaluation properly. And please think, am I ignoring, or am I mistakenly missing some points here? You have to take some effort in read the question and getting the understanding. In this question, it's very simple cash flows. There are no much revenue cash flow and complicated cash flow, only few cash flows. So make sure that you have taken all that, right? And those are the things on the question number 1. Question number 2, as I mentioned earlier, December 2020 paper tested this property development company. They talked about apartments and hotel, apartments and the commercial property opposite Golf Face. That was the question they asked. And there also they talked about when you are going to lend money as a banker, what are things to be looked at. So similar thing is tested again. So you have to have some knowledge on the previous paper and make sure that you are aware of it, and more than that you should be able to consider what are the other risk factors you have in that kind of property development and when you are going to fund it. And property bubble, these are things, okay, maybe that in the financial management you would learn separate topic, but when you read regularly business newspapers, when you read the today's context, environment, what's happening in the environment, these things you have to gather as a knowledge, rather than only from exam point you learn these things, right? So I am only telling because this is something, as my lecturing generally I ask people to read business newspaper regularly, so that you are aware of what's happening around you. That will definitely help you in your answers this kind of questions, okay. Then the question number 2, the B part, the areas where the mistakes were noted. One is that calculation of the exchange rate for 60 days and under 80 days. Right, even though they are given 5% depreciation for 1 year, students have not taken that calculation properly. Then the extra premium due to the credit period extension was not considered by some other people. Then attempting in calculating the numbers, the extra interest saving, people have missed it. And some students have taken the spot rate 185 as the exchange rate. For the question number 2 B part, you have taken 185 is a relevant exchange rate. No, 185 is for accounting, you can take it. But when you are going to take payment point of view, 60 days if you are going to pay your LC, you have to take a 60 days credit exchange rate. If it is 180 days exchange rate. This is not forward exchange contract. Forward exchange contract, you can say, okay, I have got into forward exchange contract for 2 months or 6 months, I can agree the exchange rate today, that exchange rate you can use. But here it's about spot rate is today's exchange rate. And 2 months time your exchange rate will vary. So LC, when you are going to settle in 2 months, you take the respective exchange rate. So that is something people have not taken. Then question number 2C part, the common mistakes of the students. 3 billion investment by the Pringley, that foreign company. Since the local owner is given 25% ownership without putting any money, some people have divided the 3 billion as 75 and 25. It's wrong, because 3 billion is invested by the foreign company. Sri Lankan company no investment, but he gets 25% shares. So it's a promoter shares. So that fact has not been considered. And some people have not considered the withholding tax when the calculating of the valuation and the dividend cash flows. And some people have made mistakes in CAPM formula also. Please understand, CAPM formula is something, it's must for your computation. So you have to take CAPM as a serious note, because everywhere you will see that every case study you will have a CAPM calculation. So you have to make sure that CAPM is very clearly understood, what are the factors included there, okay. So those are the, most of the people have answered very good in a way of the ratio calculations. People are aware of the ratio calculation, those are good things. So please note, these are the some of the comments I am just discussing, so that make sure whenever the question is asked, read that question properly and see whether you have considered every aspect. Don't miss out anything. I know the time pressure is there always. As a student at the exam hall, your time is under always limitation. But try much as possible to answer every aspect so that you score marks, because you know that it's a competitive exam, you are not able to get 50 marks, mean you are not through. So you have to try much as possible to answer much of the questions, okay. Moving to question number 3, the case study question. As I mentioned at the beginning, the case study, you will be given a pre-scene, even for this paper you had a pre-scene. Actually this pre-scene was the June 2020 pre-scene. Since the COVID-19 was there in the period, June paper was not held, the exam was not held, so it was held in December. December it was online examination. So the December exam, the same common pre-scene which was issued at that time for June was used. Same common pre-scene was used for the March exam also, this exam paper. So what I would like to request you, the common pre-scene discussion, it's like 1 hour and maybe more than 1 hour. You will see that in SL2, 26 February 2021, session 2. This is a webinar I have done discussing the pre-scene when I was discussing the December paper. Since the pre-scene for December paper and March paper is same pre-scene discussion. Pre-scene discussion is before the exam you are looking at the pre-scene analysis. So as I gone through in the February 2021 webinar, that's in the Chartered Institute webinar, this webinar you can look at it. You can look at under my name. This is discussed. So 1 hour, I think more than 1 hour, 1.5 hours, I think I have discussed the pre-scene of this paper. So this same pre-scene is used for the March paper. So I am not repeating that today, no point. So you can go through that video and get to know the pre-scene analysis. Then move into the today's session for this question number 3. Okay, please do that. So that's otherwise it will be just a repeat telecast I go to do. Then moving to the unseen material of the section 2, unseen material of section 2. So if you read out, if you have gone through the go through the case, there are 2 board papers they are talking about. Actually we have to answer the 2 board papers. One board paper, it's about the company going for listing and evaluating the strategic business unit. So there are 2 board papers. One is about listing, other one is SBU. Sorry, one is the first one itself, there are 2. In the board paper 1, there is a one, if you take A, listing, then SBU evaluation, strategic business unit evaluation. 2, it's about the buyback of shares of Bangladesh operation. Okay, you please go through the pre-scene and then you can continue so that you will understand what I am talking, right. So SBU evaluation and listing is under board paper 1. Board paper 2, this is unseen, we are talking about unseen, buyback Bangladesh. So it was about a company called HCL, which has 5 segments, FMCG, fast moving consumer goods, and they are into health related, where they have the laboratory, hospital, pharmaceutical. Then they have 3 kind of non-performing segments. Those are the ones which will be discussed in this B part. The 3 segments they are talking about, one is leisure, which is hotel industry. Second, they are talking about power, wind power plant, 5 megawatts. Then they are talking about logistic business. So there are 3 businesses, they are not performing well. But 2 businesses they are doing well. One is about fast moving consumer goods, other one is healthcare. Those are 2 businesses which are so important segments of the business, and they are doing well. So now coming to question number A part on the unseen material, you will be able to read the unseen material, board paper 1. Question A part, discuss the limitation of the market-based valuation technique. In response to the chairman's request, and recommend a market-based valuation range for HCL with the information available. So if you read the A part, what they are saying, discuss the limitations of market-based valuation technique. So A part has 13 marks question. So one is discuss the limitation of the market-based valuation technique. Second, recommend a market-based valuation range for the company. And note, you have communicated to the HCL, board of directors that you would use PE method and EBITDA, that is enterprise value divided by EBITDA, multiple based valuation for this purpose. So please note, in the pre-seen material, they have given you under page number 10, two competitor information. Generally, when you are given pre-seen material information, competitor information, please understand, you are expected to use the proxy company or the competitor company information to value your company. That's generally the expectation. So the examiner in the unseen material very clearly said, the chairman wanted you to value the company using market-based valuation. So now what is the market-based valuation? There are certain valuation techniques which you are using the valuation technique to value the company based on the inherent cash flows, nature of the company or the business. So those ones are dividend cash flows method, and the free cash flows method. So dividend cash flows and free cash flow methods will be of the respective company cash flows, and you use your discounting factor or discounting rate and value the company. So this is your valuation of the respective company based on their cash flows or their information. There is another type of valuation you might do, that is, you use the market information or the competitor information or the industry information to value your company. That is where the price earning ratio, price to book value ratio, and this question talks about enterprise value to EBITDA method. All these multiples can be used to value the company. So these are two bases. One is about you are using the company information, other one is you are using the market information. So the company in the unseen material, they have said that they have already appointed a company to do a valuation of the company using discounted cash flow method or the free cash flow method, which is generally the important and comprehensive method of valuation. Free cash flow method is the ideal method for a company who is trying to buy the company. Anybody who is want to buying a controlling interest of a company, you need to use the free cash flow method of valuation. Dividend cash flows also you can use, but dividend cash flows have a limitation in the sense like it is considering only dividend cash flow, not the total cash flow of the company. Therefore, dividend cash flows could be used for mainly minority shareholder investment rather than controlling stakeholder. But controlling stakeholder, it's a free cash flow method of valuation is more ideal. So we need to know the difference and the purpose of using different methods of valuation. The price earning method and the EBITDA method in this question they are talking about, these are the competitor information which can be used to value your company. Your company HCL is an unlisted company, and now only they are going to go for IPO. So in order to go for IPO, you need to value this company. So chairman has said, why you are waiting for free cash flow or late 4 weeks of time you are taking, better use the market information and value the company. Now we need to tell the chairman, market valuation basis have certain limitations. So what are limitations? That's what we have to talk about. One is comparable competitor company information not available generally. You cannot consider or you cannot obtain competitor company information similar to your company. Maybe your company is small, maybe the competitor company is large. Maybe your company have a group, competitor company may not be having group. Now your company in this case, you have 5 segments, but within one company, you are not a group, you have one company with 5 segments. But if you take the competitor company, it may be diversified group. So the structure is different. So in that case, your exact comparable information you may not be able to get. Then the PE method when we are using, you may not be able to use the proper PE, because it will be representing minority shareholder transaction. It's not majority shareholder or a controlling interest. So minority shareholder transaction only represented. So PE, whenever we are using, you may be needed to do adjustments which are arbitrary. So that is a disadvantage of using the competitor information. You may not get the PE properly, then you may do the adjustments for arbitrary. Then again, PE, if it is volatile earnings company, PE may not be represent properly. Then you might have to use couple of years PE ratio. So if the volatility they are in the earnings, you may not be able to use the current PE ratio. You may have to take couple of years of PE ratio. So that is a limitation in PE ratio calculation. Then the information of the competitor, capital structure and the ownership structure could be different when we are using the competitor information. Like the competitor company's ownership structure can be different, capital structure can be different, so you may not be able to use the same information as it is to value the company. So there are various information. Then when you say market based information, when market is not normal in the sense, like you might say certain times the market is unfairly valued. That can be overvaluation or undervaluation. So when you are going to use the market based valuation, you may be valuing your company also unfairly. If the organizer, I know that 2019 December or before, if you take Sri Lanka stock market, there had been enough companies were undervalued. Even though they are very good companies, there are enough good companies, still the share price is very low. Like net asset values are more than the market price. So what does it indicate? That your companies are undervalued for the market. The market environment is not good or stable, its stability is not in the country. Certain reasons your market shares are undervalued. In that case, you can't use a market based valuation, then you are valuing your company also unnecessarily undervalued shares. Or sometimes it is opposite, where you will overvalue the shares because market is also overvalued. So market is not normal, then the limitation is there in the market based valuation. Okay. So these are the couple of reasons. You can look at the suggested answer also for some other additional thing. Then they are talking about valuing HCL, using this competitor information. So HCL, we have to value the shares using the competitor information. As I told you in the pre-scene, page number 10 of the pre-scene, you have been given two company information, DEF and GHI. There are two company information given, and they are given 2-year information, 2019 and 2020. So according to 2019 and 2020, we can calculate the P ratio. How do you calculate P ratio? P ratio equals to market price divided by earning per share. P ratio equals to market price divided by earning per share. Page number 10, Pre-seen material you have been given for 2019 and 20 for both companies, market price and the earning per share. Market price and the earning per share. So we can calculate the market price 34 rupees, earning per share 2.56, 34 rupees divided by 2.56. So you can calculate for DEF. What is your P/E ratio? (13.28 times). 13.28 times, and 2020 same way you can divide the market price 44 rupees. 44 rupees divided by 3.64. 3.64 earning per share. That gives you 12.09. GHI. You can take the market price of 54 for 2019, 54 market price divided by earning per share 4 rupees and 30 cents, 4 rupees and 30 cents, that gives you 12.92. 2020, 58 rupees divided by 4.79, 58 rupees divided by 4.79, which gives you 12.10. 12.10. So this is your P ratio of two company competitive information. Now what do? We need to value HCL using this competitive information. So you have been given P ratio for 2 years of two companies. So we take the average. You take average. Generally you might have taken the latest year. But when you are given two competitive information, you take the average of that for both years. Why I am taking both years? Because already we talked about limitation. So to reduce the limitation on this information inconsistency, we take the average. So average is this is average of 2020 and 2019, average of 2020 and 2019. So based on that, we need to value HCL. HCL, we can look at the 2019, 2020 earning per share, 2019 and 20 earning per share, HCL. That you can take it from the pre-seen. You can take it from the pre-seen. Pre-seen of HCL, page number 14, that is HCL company's profit and loss account, 2019 2.42, 2020 3.19. This is your earning per share. 2.42 and 3.19. P ratio, we take the average 12.92, 12.10. 2 years, we are taking the 2 years price. Then market price, your expected market price based on P ratio method of valuation, 31.27, 38.60. 31.27, 38.60. Generally, you would have taken the latest year, 2020, and done. But to reduce the inconsistency in your PE in the market, we are taking the average. So you take 2 years and take the average of this. So your market price average is going to be 34.93. So under PE method of valuation, we have taken two competitor information. We got the PE ratio and taken an average for both years. That average both year you apply to the HCL company earning per share and get your market price. Since you have got two market price for 2 years, we take the average market price which represent the reasonably the market. So 34.93 is the PE based valuation. 34.93 PE based valuation, 34.93 your estimated value. The second method of valuation, enterprise value divided by EBITDA based valuation. Enterprise value divided by EBITDA method of valuation, like a PE multiple here, enterprise value divided by EBITDA. Again, two companies, DEF and DHI, DEF, GHI, you can calculate in the pre-seen material again. So, enterprise value given for 2019 and 20, DEF 8450 divided by 1300 EBITDA. So, 8450 is your enterprise value divided by EBITDA 1300. That gives you 6.5. Then you have 7.10, same basis you can calculate for 2 years, 6.90 and 7.95. And the average, like what we did for PE ratio, we are just getting average of the two companies first, 6.70, 7.53. This is the average of the company, two companies. Then we apply that to HCL. HCL, first of all we have to find out what is the company EBITDA. So, EBITDA of the company, EBITDA of the company. So, can you take the pre-seen? They have told you on the unseen material, both years, unseen material, both years, they say, both years HCL will have amortization and depreciation of how much? 500 million. So, they are saying your amortization and depreciation is 500 million. Amortization and depreciation 500 million. So, EBITDA 2019, 2020, EBITDA 2019 and 20, 2019 2,223,000,000, that is operating profit. EBITDA is operating profit. EBITDA means before depreciation amortization, what is your operating profit? So, operating profit is 2,223,000,000, that added with 500 million, that means 2,723,000,000. 2,2723,000,000. Same thing for 2020, 2,954 is your operating profit, you add it with your 500 million depreciation, 3,454. So, this is your 2019 and 20 EBITDA. Then we have got average ratio between these two, enterprise value and EBITDA. So, when you multiply 6.7, that is your this ratio for 2019, 2020 7.53. So, you multiply these two, this is your EBITDA, this is your ratio. Then what you get is a total enterprise value, So, I have to raise this. Total enterprise value, when you multiply 2723 by 6.70, 18, this is 2019, 20, 18, 249, 614, and you take thousands, rupees thousands. 2020, same way you multiply it by 3.4 by 7, 26, 015, 833. So, that is your enterprise value. So you can take the number of shares. In the balance sheet, it said 59 billion number of stated capital, 59 billion. In the pre-seen material, you can see the stated capital. Sorry, 5.9 billion. So the number of shares is 596 million. I am rounding off, 596 million. So if your number of shares is 596 million, this is your enterprise value, this is your number of shares, then enterprise value per share. You divide the value by the number of shares, that gives you 30.62, 43.65. Then you take the average of this, since we are taking 2 years, we take average of that, 37.14. This is your enterprise value per share. So 37.14 enterprise value per share. That you minus, because when you order to calculate enterprise value you got is 37.14. From that you minus debt per share, debt capital per share. So here the definition, I think under pre-seen discussion I assume that overdraft is not part of debt, but it depends on how you want to take it, right? So you have two ways of taking it. If the overdraft is your permanent debt capital or permanent long-term nature, then you take it as a debt capital. Otherwise you ignore it as a long-term capital and you take it as short-term capital. So in the pre-seen I told that you have the choice. Of taking the overdraft as a short-term debt or long-term debt. So in the example in the pre-seen, when we are looking at the initial calculation, I said the overdraft is a part of a short-term, so we ignore it. But here I'll take the overdraft, the assumption I take now in the unseen level, short-term and long-term bank overdraft all together, I have a total value of 3332,071,000. So when I divide by number of shares, 596 million, 5.59. 5.59 is the debt capital per share. Then please note, in order to calculate enterprise value, you have to add the cash. So cash balance, they said 73 million. Cash balance, in your balance sheet you have 73.63 million, 73631, and number of shares is 596 million shares, then 0.12 per share. You have to add it. That gives you market value per equity share 31.67. Market value per equity. Share 31.67. So please note that the differentiation you should note. Normal valuation, we value the equity, but enterprise value is where you are valuing not only the equity, you value the debt also. So the enterprise valuation is what you calculated here, right? That's what we do the adjustment, right? From the enterprise value you minus the debt and add the cash to get the equity value per share. So this is what we have done. So the examiner now wanted your price range. PE method is 34.93 and enterprise value EBITDA method, it is 31.67. So average value, if you take the two methods, average of this, you can say 33.30. So the price range, so the valuation per range based on market-based valuation, it is 31.67 to 34.93. This is the range of values for the valuation, range of value for valuation. So this is a question where the examiner wanted first to say that there are limitations in market-based valuation. Ideally, we should be using the dividend cash flow or free cash flow methods to value the company, which is a comprehensive method of valuation. But market-based valuation is also possible because where you use the competitive information to value a company. Your company being a unlisted company, you will take the listed market competitor information and value your company. So we have used that base to calculate two methods of valuation. One is PE method of valuation, other one is enterprise value EBITDA method of valuation. So both ways we have calculated and we have got a range of 31.67 to 34.93, 31.67 to 34.93. Okay, so that's your A part of the question. You can look at the suggested answer, right? Actually, suggested answer, you can look at it. B part of the question. With reference to point number 2 raised by the chairman, evaluate as to whether profit-based decision making would be misleading. Evaluate as to whether profit-based decision making would be misleading. Profit-based decision making would be misleading. So that's basically the question. So according to chairman, if you read the question, what he says, the company profit based, that is operating profit or the EBIT, operating profit divided by sales. So based on this, you are making decisions. But he had gone for a seminar and he identified, they are talking about, there are 4 key parameters: return on equity, cost of equity, return on investment, weighted average cost of capital. So they are saying like you need to look at that relationship and evaluate your company performance rather than just looking at the operating profit based. So he would like to see an independent evaluation done for these parameters for leisure travel, logistic power. There are 3 non-performing segments. I told you non-performing. The listing part we have done, the valuation. SBU evaluation, that is 3 segments. So he wants to say that the company have been tracking operating profit as the key for justifying the going concern that had been done in the past. The finance director has already received following tabulated information calculated by an expert on the available information. So they have given you the cost of equity, cost of debt, return on equity. The table is given in the unseen material. So the question is asking, question B part, evaluate as to whether profit-based decision making would be misleading. So please understand, when you are going to evaluate the performance of a segment purely based on profit like this, operating profit divided by sales, is it going to be misleading? The answer is yes. Why? Operating profit is, yeah, you can use the operating profit based evaluation also part of your total evaluation. Not only the operating profit based. Why? After operating profit, there are key items in your P&L. What are the items? Your tax, your interest, and your return to shareholder. So even though your company can say, I made operating profit, if the shareholders didn't get their return what they wanted, then your performance is not good. Right? Ultimately, your primary objective is maximize shareholder wealth. If the company says, okay, I have made operating profit, but shareholder returns is very low, then shareholder is not happy about the company performance. So please note that operating profit needs to be earned. Operating profit needs to be earned, but you need to earn more than operating profit, return to shareholder also. So in that process, you have to make sure that you are able to pay the taxes, you are able to pay the interest, and you have sufficient return to the shareholder also. So there are 3 situations or payments: tax, interest, this is the government you have to pay, this you have to pay the banks, this pay return, what is your net profit to shareholder. So these three has to be looked at. These three have to be looked at when you are looking at the evaluation. So please note, the Roman number 1 is asking whether a profit based decision would be making misleading. Yes, it will be misleading because it's not sufficient. Not that it's misleading, it's not sufficient because you need to evaluate some other factors also in evaluating your company performance. Okay. So then moving on this company, the company we are talking, the three segments, we have to look at their operating profit levels. So if you take the three, leisure, logistics, power, you will see their segment revenue and their operating profit or EBIT. Segment revenue, you can look at it in the pre-seen material. Pre-seen material, page number 18. You can see the leisure, the segment revenue 3846. If you take rupees millions, 3846, logistics, your revenue 2564, and power and energy 1923. This is page number 18 of the pre-seen. Now you see that whenever there is a pre-seen, one of the examiner comment is that some people are not able to relate the pre-seen to the unseen material. True that pre-seen is a very lengthy document, but you have to, that's why the pre-seen is given 2-3 weeks before the exam, so that you can go through, analyze and understand the whole case. You will live with the case. When you go to exam hall, you don't need to memorize anything, but you need to be knowledgeable that there are certain things we have to relate to the pre-seen and get it. So operating profit calculation, this ratio has not been given in the question unseen material, so we need to calculate. The majority of students have not touched this, but you can calculate the operating profit relationship between sales and the operating profit. So operating profit, this is 152 million, this is 26 million, this is 19 million. So this is operating profit. Then your EBIT to sales ratio, EBIT to the sales ratio, this is 4%, this is roughly 1%, this is also roughly 1%. So based on this, you can understand that this is basically nothing. Even though leisure is making some return, other two segments are basically not earning sufficient return, because if you don't earn operating profit, you can't pay the interest, that's finance cost for the banks, and you can't pay taxes, and you are not able to give return for shareholders. So shareholders are not happy about your return. So this is basically your situation for the three segments. That's basically your Roman number 1. Roman number 1, B part, Roman number 1, that your segments operating profit consideration shows that these two or maybe the three segments are not performing well based on EBIT level. Even though it looks like they are making profit, slight a profit, from the overall shareholder point of view, you are not earning sufficient profit. Okay. Then the Roman number 2. The question is, evaluate the performance of SBUs based on the 4 key parameters and suggest 4 strategies that best suit the problematic SBUs to come out with the current. So there are 2 parts in the question, 16 marks. One is evaluate the SBU performance based on 4 key parameters and suggest 4 possible strategies that best suit the problematic SBUs. So please note, there are 2 comparisons. One is cost of equity and return on equity. Other one is return on investment and weighted average cost of capital. So you need to compare this. Return on equity is what the company has earned for shareholder. Cost of equity is what the shareholder wanted. See whether your company has earned for the shareholder. 1. Second, see return on investment, WACC. This is considering not only shareholder, equity holder and debt holder both. So here, first one, we are looking at only shareholder point of view. Here we are looking at shareholder and debt holder point of view. This is what they wanted, whether you have earned that. So this comparison 1 and 2 needs to be looked at for any sustainable performance of a company. Not the operating profit, you look at it in a manner, see whether sustainable businesses, whether your organization is earning sufficient return for shareholder and debt holder, then shareholder point of view, whether you are earning return expected by the shareholder. So that's basically your parameters. I think the examiner has given you the parameters there. So I think there you need to calculate 3 sectors: leisure, logistics, power. 3 sector, cost of equity, return on equity. These 2 parameters are given already in the unseen material. Cost of equity and return on equity of 3 sector. Cost of equity 15, 17, 19. Return on equity 11, 10, 15. So you can see the negative spread. Negative spread is there, 4% here minus. That means shareholders are expecting 15%, but leisure sector is earning 11%. That is 4% short. Here shareholders are expecting 17% in logistics, but return on equity 10, 7% negative. Here power sector shareholders wants 19% and you are earning 15%. That means 4% negative. So this is a negative spread comparing the return requirement of shareholder and what you are earning. So that is your one comparison basically, which shows that all three segments are not earning sufficient return for shareholder. Their expectation is this, what you are earning is this, not at all sufficient, you are having negative return for them. So this is your first comparison we are doing. Second comparison is basically the second parameter we will do leisure sector, logistics, power. There we have to compare return on investment and WACC. WACC is given for each sector 13%, 14%, 15%. WACC is your average cost of capital of your capital, total capital. That means debt capital and equity capital both together. What is the average cost you have? That means company has taken money from shareholder and debt holder. They are expecting a return of 13% here. And how much you are average earning in leisure sector? Logistics, how much you are earning? So you have to calculate that and compare these two. Right? That is considering both investor, shareholder and debt holder. So if you take the return on investment of each segment, you can calculate by comparing EBIT divided by average assets. Right? EBIT divided by average assets. These are in page 18 of your segment. Page 18 in the segment analysis. In your pre-scene, page 18 in the segment analysis. You can take the EBIT of each three sectors divided by average assets. In your page 18 segmentation you have. You take the return on investment. So you can do that calculation, or if you want to look at the suggested answer, the answer. Right? So you will see that your return on investment here 7%, 2%, 1%. So here you are talking about 6% negative spread, 6%, your 12% negative, here 14% negative. So you can see that there is huge shortfall for power sector and even logistics you have a significant shortfall. So this is basically the considering debt holder and shareholder, your company had not been performing. Shareholder and debt holder both together, your performance is very bad because you have a negative spread. What they wanted, for example, weighted average cost of capital shows the cost of your funds, both funds. Power sector, the cost is 15. How much you are earning? Only 1%. So it's not sufficient, 14%. Minus 14, 12. That means overall, you are not earning sufficient return for debt holder, neither shareholder. So the both parameters shows that your company is not earning sufficient return for both stakeholders. So that's basically the final answer. Even though the operating profit, when you compare, you might say that sometimes the profit is there, so you can run it. I think the management has said that there is operating profit in the company or segment, so we run the company. But actually speaking, the operating segments do not, operating profits do not really reflect your real picture. Real picture is where you look at your shareholder return and see whether you are earning sufficient return. So in that case, both parameter comparison, we can say that company is not able to earn sufficient return for shareholder, neither debt holder, which means you should not be running this company unless really you want to do that businesses. Then the second part on that question, on the second part, it says possible strategies. Your possible strategies that best suit the problematic SBU to come out of the current situation. What are the strategies you can suggest to come out with this situation? Firstly, we understand that leisure sector, you just take leisure sector, you are profitable only current year, but last year it's lost. But we know that 2020 March is the final financial year. 2020 March, the COVID started. So subsequent period we don't know. So if you analyze the post-COVID situation, and if still you believe that it's going to be a very negative situation, environment, it's better that you sell. You sell the hotel. You sell the leisure sector. Sell the leisure sector. First you look at the post-COVID situation and whether it's improving or it's expected to improve. If you not see that improvement, better you sell it. But if it is improving, then you may continue your operation, because it's time to come you will have more business and your tourism will start booming, then you can make money. Even though short term may not be able to, but long run you can do that. But that is after you analyzing the post-COVID situation. Then in terms of logistics and power, you need to see that their shortfall is very high. First see whether you need to reduce overheads and the investments, or reduce overheads and investment in the power and logistics. If not possible, if you think it's not possible, then you need to sell or discontinue. You need to look at that, whether you can reduce the overheads and can turn around the company, or avoid the further investments and turn around the company. Otherwise, if not, you can sell or discontinue the business. Then idling assets, you can dispose. As I mentioned in my pre-scene, the power sector, especially renewable energy power sector, has got a lot of opportunity in Sri Lankan environment, because government wants that industry to be concentrated and developed. So we need to, I would say the power sector, we need to further evaluate what is the key problems in the power sector company. Right, what segment, this power sector segment, why we are making losses. We need to evaluate seriously and decide. Ideally, you need to see that if there are ways to sort out, better to sort out, because this is the opportunity of business. It's not something like you just close down. You need to look at, definitely there is something wrong in this investment or the way we have structured, something has gone wrong. So go through and see whether we can correct it. If you have corrected, please do the correction, because this is the future. These are opportunities in these segments. Renewable energy sector have opportunities, so you need to look at it, what has gone wrong, and correct those things. So you can go through the what you call the unseen, or what you call this suggested answer also, and find out what had gone wrong. Further, you can do aggressive market share increase, especially this is for logistics. Do aggressive market share increase, see whether you are able to make profits, because sometimes you may be at a initial stage where your fixed overheads, operating leverage is very high, the fixed overheads are very high. So till you get into a minimum amount of your break-even sales, you are loss making. After that point, you will start making profit faster. So you need to see whether I should do an aggressive market share promotion and increase that. By doing it, I would be able to make profits. So that's basically the 4 strategies to improve our SBU's performance. So whatever the SBU non-performing, you need to analyze. In detail and identify idling thing, right? Wherever you have invested heavily and not making use of that investment. If you have to do promotion to get more market share, more sales, you have to concentrate on that angle. That's what we talked last. And certain ones you might have gone wrong in your decision making in the past, so you correct those decisions hereafter so that you can make money. And then you see that unnecessary overheads, if you have spent unnecessary overheads, cut down those overheads and cut down those investments so that you can make business out of it. Otherwise, you sell or discontinue. And leisure sector, as we know that it is a bad environment at this moment, but if you see a long run, you will make money, and there is a very good opportunity. Might as well wait for that time, and till that time we have to try to find out how to survive. Maybe that we can use the hotel property for various other things. You all know that today's context, there are certain hotels are converted as intermediate care center. Government is using that, so you get some money for that, your hotel premises. So your incomes are generated, and you can sometimes you can start delivering online, delivering orders, food can be delivered. So there are various other things you can be doing for temporary arrangements till the situation improves. So that is for leisure sector. So these are some of the idea you should be thinking to improve your strategic business unit. Still, if nothing works, nothing seems to be working in your organization, better might as well close that segment or dispose that segment. Okay, that is basically the SBU evaluation. I think the both one was talking about valuation and the SBU evaluation. So we have done both in the question 1 and 2. Then the quick one, the 6C part. Six marks question, C part. Display your independent opinion on point number 2 and 3 raised by chairman on differentiated cost of equity and whether HCL company valuation would come down in the event one or more SBUs are shut down. So there are 2 parts, C part. So one is talking about point number 2 and 3 raised by chairman. Point number 2 and 3, where he said chairman disagrees on the differentiated cost of equity between SBUs, because he is saying that you should have one cost of equity for one company. Even though we have different segments, you can't have different cost of equity for different segments, because the examiner has given you cost of equity for leisure 15%, logistics 17%, power energy 19%. So cost of equity differing every segment. So chairman is saying no, shareholder is responsible for all the segments. So shareholder return requirement should be common for the entire company. This is something in the pre-scene we discussed, where finance director says that we need to convert this segment into companies. Rather than keeping the segment as the division, we need to convert as a company. Why? Then you are looking at the division or looking at the segment evaluation properly, because your performance is evaluated properly, and shareholder point of view, you have returned for that segment separately and you have to make money for that. If you don't make money for that, you have to decide what to do with that company. But when you are part of a group, one company, 5 segments under one company, your segment may not be performing, but there are maybe some segments like FMCG and healthcare, they are performing, they are making money, and you are basically loss making and surviving within the company. So which is not something you should be allowing. So that is what the pre-scene, when we are talking about, we discussed that chairman, even though he believes it's as a one company, but finance director says no, we should have segments are one part of company, so he is trying to do that. So here the question is about chairman's statement of differentiated cost of equity. He said don't use differentiated cost of equity, even though it's one company, we should have one. The answer is systematic risk. Systematic risk of each business. Each business is different. You cannot expect different industry or different businesses to have same systematic risk. We know that risk is there in every business, but risk level and the difficulties you have to go through in that industry could be different to the other industry. It's not the same level. Some industries you have to go through more riskiness, some industry you have to go less riskiness. So basically systematic riskiness of each business segment is different. Therefore return requirement of shareholder for each segment also differ. For each segment also differ. So please understand that systematic risk of each segment is different, so the return requirement of the shareholder should be different. So what the information given is correct, chairman's view we should correct, saying that systematic risk is different, so you cannot have same cost of equity for each segment. Even though they are one company's division, the riskiness is different, so the return requirement of the shareholder should be different. Okay, that is one part. Second part, he says in the event we shut down or dispose the SBUs which are not performing. In the event we dispose or shut down the low performing SBUs, will that be an impact to the valuation of the company? We are disposing or shut downing the non-performing SBU. So when you say non-performing SBU like leisure, power, logistics, when you are cutting down the loss-making division or segments, value of your company, what happens? Increase. Value will be increasing. Why? At this moment, your non-performance is offsetted by good performance by FMCG and the healthcare. When you remove your losses, your company's actual profit will be more than what you are doing now. Why? You are a loss-making divisions. So please note, when you remove the non-performing segments from your organization, your value of the company goes up. This will be helpful for your IPO also, because your share price goes up. So this is the second part of the question, where the chairman is worried, if we remove the non-performing SBU, will that be an impact to the share value? Then it's a very genuine question, because you have been running 5 divisions and you are a large company, and suddenly you say there are 3 divisions we are closing down. Will that be a negative thing for the share price valuation? No, it will be a positive impact, because you have been making losses, your cash flows are wasted, you are not earning return for your investment. We looked at earlier, negative spread is there, that means you are not generating sufficient return for shareholders. Since you are not generating sufficient returns, your negative returns are offset by the good performing 2 divisions, that is FMCG and the healthcare. So when you remove that, your other 2 divisions real profits will be highlighted, your value will go up, share price will go up, and your IPO purposes it will be a good thing. So that is basically the 6 marks question. of the C part we have looked at, right. So the last part only we are left with, right. So we will be discussing on the next session of the last part. We were on March 2021, question number 3, the case study question. We tried the ABC parts. ABC parts we already discussed. What are the clarifications or the questions have been asked, and we discussed on that. Then moving on, D part. D part actually the 15 marks question. It's the last part of the paper, 15 marks question. The examiner wanted, basically the question is about, as the main shareholder of the Bangladesh company, HCL, that is a local company, is interested in the share repurchase proposal despite the negative sentiments made by the management accountant. Advise the chairman of HCL with your independent viewpoint on the proposal if 30% of the shares are going to be repurchased by HCL BD. Your opinion should be supported with an income statement, financial position analysis, valuation based calculation, qualitative factors if any, 15 marks. So if you really look at, it's about the Bangladesh investment. I'm sure like if you have looked at the pre-scene material, page number 6 pre-scene material, where the company, they say about the, apart from the 5 segments of businesses they are in, they just entered page number 6 of the pre-scene, it just entered, first paragraph of the page number 6, it just entered the international market by buying 35% of HCD BD. BD is a Bangladesh, they are meaning 35% of HCD BD, and introduced the HCL brand, that's a local brand, to the international market for the first time. However, HCL should carefully consider India and other parts of the region too in order to develop its market potential. So that paragraph talks about the Sri Lankan company, apart from that 5 segments they are already in business, they have gone and invested in a Bangladesh company, and they bought 35% ownership. If you looked at my pre-scene analysis, where we would have said, since you have invested 35%, there is a potential that you could increase your ownership. There is a potential that you can increase your ownership, because when you look at the pre-scene, page 19 and 20, which basically gives you the P&L, income statement, and the financial position or balance sheet of the Bangladesh company. So when you look at the P&L or income statement of Bangladesh company, it has 630 million rupees or 297 million Bangladesh currency profits, which means very good profit the company has, when you look at it. So when you look at it from the investment or the diversification going to a different market, it's a good investment. Why? You have a profitable company, and where you own 35% ownership, and you have invested in your balance sheet. If you look at the balance sheet of the HCL company, the investment is shown, page number 16, investment in HCD BD is 984,500. So we are talking about 984.5 million rupees is the investment in Bangladesh company. So just to understand, investment in Bangladesh company is 984.5 million, which is 35% ownership. And the Bangladesh company had made last year profits of the Bangladesh company last year, which is roughly 630 million. That's the total profit. So what we can understand, 630 million is total profit of the Bangladesh company, of which you say 35%. So you get a significant profit you are going to earn, right? You have 630 million into 35%, which is 220 million. So you are talking about 220 million profit. The Bangladesh investment has generated for the last year. Bangladesh profit or Bangladesh business has generated 220 million. So when you compare this investment against the profits, so you are talking about 220 million, which is 35% of your profits of Bangladesh company, and you have invested 984.5 million, which gives you 22% return. 22% return. So what I would like to first say, if you look at as a Sri Lankan company, you have invested 35% in Bangladesh company, which in Sri Lanka rupees you have invested 984 million. So 35% you have invested in Bangladesh company. That company had made for last year 630 million profit. 630 million profit. If you take the 35% of that profit, you are talking about 220 million profit. So 220 million profit you have earned, the company has earned, Bangladesh company has earned in Sri Lankan rupees for the 984 million investment, which is roughly 22% return. 22% return. So it's very, very attractive return. Very attractive return the investment is generating in Bangladesh. So when you looked at from this pre-scene level, we can understand pre-scene level the investment is generating good return. So what is the possibility? You would like to increase your stake. You would like to increase your stake in the Bangladesh company. Why? It's generating a good return. So you have more opportunity to earn more money when you are developing or expanding the markets in that area. So that's basically the pre-scene level we would have talked about. Now the question is talking in the unseen material. Unseen material, they say, if you read the unseen material question, even though the paragraph what they are talking, if you look at it, board paper 2 and the unseen material board paper 2, what they say, share repurchase proposal evaluation. So the Bangladesh company, one of the or the second largest shareholder of Bangladesh company has decided to retire from business. Now we own 35%. So we are the main shareholder. Second largest shareholder owns 30%. He is now willing to withdraw from the business or retire from the business, and he is saying if the company can pay him 30% of the company market valuation. So you have to value the company. Of that 30%, if you are willing to pay, and they have given you the valuation way of calculated based on earning before interest, tax, depreciation and amortization, EBITDA, for the most recent year, adjusted for 40% increase in revenue and cost of sales as further explained below, multiplied by average industry multiplier of 6 to arrive at Taka 13.2 billion. So basically what they are talking is, you need to value the company, the Bangladesh company, and you calculate the 30% ownership. That 30% ownership, your valuation based on what they are suggesting, you value that company and work out 30%. That money, if the Bangladesh company willing to pay that to the main shareholder, second major shareholder, then the second major shareholder is willing to withdraw from the business. So it's actually share buyback. Bangladesh company buying its share from one of the main shareholder, one of its shareholder. And then the second paragraph they say, rest of the key shareholders also have taken this offer seriously, does not have any profitable investment at the same time. One is that other shareholders are taking it seriously. Then they say the company, the Bangladesh company does not have any profitable investment opportunity at the moment. So one is, there is one of the shareholders say, please buy back my shares. There is another side of the story is that Bangladesh company does not have attractive investment opportunity at this moment. So due to the global pandemic, so that they are referring to the present environment also, where is the COVID-19 pandemic. So they say that due to that there are no much of a investment opportunity, they are good investment opportunity they don't have. The Bangladesh company planning to use the excess cash including short-term investment held by the company for this purpose, and the balance will be financed through 5-year bank loan. So please understand, it's about a share buyback. So the Bangladesh company is going to buy back one of the shareholder shares. To buy back the shares, you need to have money. So how are you going to fund it? Funding of buyback, two ways. One is your excess cash or short-term investment. Second, your debt. You are going to borrow money. So what they are trying to say, company will be using the excess cash including the short-term investment held by the company. We are talking about Bangladesh company, not Sri Lankan company. And the balance will be financed through 5-year bank loan. So this will be a 5-year bank loan, 5-year bank loan. So please note, the Bangladesh company is going to buy back its shares, 30% of somebody, and that is going to be funded by Bangladesh company excess cash and the short-term investment and the debt. Now you need to ask question, why they are going to use their money available with them. The simple reason they try to say, there are no much lucrative investment opportunities for the Bangladesh company. So if you don't have opportunities to invest, what do you do with your money, excess money? So excess money may not be earning enough return. So might as well you buy back the shares, buy back the shares. So that is one of the purpose they want to buy back the shares, even though there can be views of the other people. But then when you look at it from the shareholder point of view, that one of the major shareholder point of view, he will be able to exit from the investment at a good price, Why? You are going to value based on the market value, and you will be exiting from the investment. So the local shareholder, second major shareholder point of view, he will recover the investment at a right price. The other shareholders, balance shareholders of this company, including local Sri Lanka HCL company, the advantage would be that you don't have investment opportunity at the moment. So your excess money may not be earning enough return. So might as well you give the shares back to the, or you buy back the shares so that your money goes out, and then share ownership, shareholding comes down. Then what happens is, basically balance shareholders, 70% of balance shareholders will be sharing that 35% of the 30% of the first share or second shareholder. So you understand what I am trying to say? When you say you have shareholders, you say HCL, which has 35%, and there is a second major shareholder who has 30%, and then others, right? Another 35%. So when you say you are no more, this ownership is not there, second shareholder is not there, then the balance shares, number of shares, will be among these two people. So in other words, you are presently 35% ownership, and there are outsiders another 35%, and there is a second major shareholder 30%. So when you say you buy back your shares 30% to the company, then balance shares, it's like this, 35-35, that is equal. That means you are going to own 50% of this company. The Bangladesh company will be owning 50% after the buyback. So this is from the other shareholder point of view, it's a very good opportunity to increase your stake, okay? It's not easy sometimes to increase the stake, even though the company is very good, profitable company. That's why I said at the preceding discussion, we touched upon saying that since it's a good return giving company, 22% return giving company, ideally any shareholder would like to increase the stake, so that I will get more and more return from that investment, because it's a good profitable investment. But for you to do that, there has to be opportunity. But here there is opportunity coming where one of the shareholders say, I am okay, I am going out of the business, can you please give me my money, my share of money, so that I am withdrawing. So 30% is something like that. So you basically pay, as a company you pay the money to them. By paying, they are out of the business, or the shareholder is no more with the business. The balance shareholders will be the owners of the entire company, and especially it's a good profitable company. So the existing shareholder would be definitely happy to share the profits of this company hereafter, because they are becoming major shareholder again. So this 35% will increase because of the one shareholder getting out of the business. So please get that into mind. It's a good opportunity for the existing shareholders. Good opportunity for the existing shareholder. And the buyback, here the reason is told where the existing shareholder want to exit, and then you are buying back the shares, right? But generally, you might see even listed company could go for buyback. That is where the listed company realizes that share value in the market is undervalued. Share value in the market is undervalued of the company. If you realize that your share price is undervalued in the market, you would prefer to buy back the shares. Why you do that? Otherwise, there can be a threat. Somebody could buy your company, or somebody could buy your major shareholding. Why? Your company share is undervalued. If you say 50 rupees per share value, real value for your company, if it is valued in the market as 30 rupees, some shareholders or some outside investor would think, okay, 50 rupees share is trading at 30. I might as well buy the shares, so that I will definitely make money in the future. So to avoid that, generally the buyback could be a preferred way of solution for this problem. But in this case, it's not like that. Here, it's not about undervaluation or anything. Here, actually, there is a real scenario where one of the shareholders wants to get out. And it's being unlisted company, the other shareholders have to buy or the company buy back the share. So, in this case, they have agreed that company will buy back. So, company buyback will be done through the excess money, which is cash and the short-term investment and the debt capital So, this is basically the scenario. If you read the question still further, the management accountant of the Bangladesh company has carried out an analysis based on the financial statements prepared for the year ended 31st March 2020. I think 31st March 2020 financials is with your pre-scene. Your pre-scene analysis have the 31st March 2020. That's what we also looked at earlier. Only thing, the management account has done this analysis modified by the adjustments as explained in the table below. So, there are certain adjustments they are talking about. Those adjustments are considered and arrive at the here is analysis. Okay. He has calculated current position. He has calculated the current position as well as new position in the event share repurchase proposal carried out. So, he is giving a table where the current position of the company. So, he calculated the current ratio, asset ratio, that is quick ratio, working capital to sales ratio, and total liability to equity on the market value basis, debt to equity on market value basis, debt to asset ratio, net profit ratio. So, he has given all these ratios, current position. What is your current position mean? Without any repurchase of shares, present balance sheet and P&L, what are these ratios are. Then he gives another table, another column, new position. If the shares are repurchased by the Bangladesh company, as we explained, the 30% ownership, Bangladesh company is buying it back. So, once it is bought over, what will happen to the same ratio what he has talked about? So, he is giving the same current ratio and all the ratios, he has given the numbers. So, when you write, just look at it, you will realize your current ratio 1.18, what is currently, current ratio mean what? The amount of current assets you have to pay the current liability. So, you have 1 rupee and 18 cents to pay 1 rupee of liability, current liability. So, you have more than 1 rupee, but it may or may not be enough, depends on the organization style, because generally the guideline we say 2:1 current ratio, but it does not matter, because sometimes even with a 1.18 you would be able to manage your company working capital without much of a problem. But then we look at the asset ratio. Asset ratio is 0.74. That means to pay your liquid liabilities, liquid assets you have is only 0.74. That means to pay 1 rupee liability you have only 74 cents, which shows that you have working capital concerns. That means you have issues in working capital management. That is current position. We are not talking about new. Current position itself you have working capital problem. And working capital to sales ratio 8%, total liability to equity 35%. So, that shows that your liabilities are, when you compare with your equity, your liabilities are not that significant. In the sense your debt capital is not significant. You can see that debt capital is 875 million. Your debt capital in a pre-seen material, we can just look at it, 875 plus 369. I am talking in Taka currency or the Bangladesh currency. So, 875 plus 369. 875 plus 369 basically, which gives you 1,244 million. So, basically you are talking about 1.2 million or 1.2 billion debt capital in Taka currency or the Bangladesh currency, 1.2 billion debt you have. I have not included the bank overdraft. So, as you know that bank overdraft, it's an assumption based. Sometimes you will consider it's part of debt capital, long term capital, sometimes you consider the short term capital. So, what is your real knowledge you should have is, like, if your overdraft is, you are dependent as a company, if you are dependent on overdraft for long term, then it's a permanent capital or long term capital. If your overdraft is only just short term financing, even without that you can manage your organization operational cash flows, then you don't have to consider overdraft as a long term debt capital. Okay. So, this company you can see that they have 1.6 billion equity and they have got 1.2 billion debt capital on the long term debt, but bank overdraft is 752 million, but last year 1.6 billion. So, it shows that it is a moving it's very significantly moving, going down. So it's not something you are dependent. If you say you are increasing your overdraft continuously, then you might consider for your growth or the expansion, you are using the overdraft as a part of funding of long term. Then it's a long term capital. Otherwise, you can consider it as a short term capital. So it's not accounting, please understand, it's not accounting. In accounts, overdraft is always current liability. But financial management, overdraft needs to be looked at whether it is needed on a long run. Are you depending on the overdraft continuously? If you are depending on it, it's not a short term borrowing, it's a long term borrowing. So in this case, the assumption I am taking, overdraft is short term. Overdraft is short term. So I don't take it part of long term debt capital, but somebody might take it as a overdraft as a long term. So based on your understanding, you say, okay, this company needs to fund it. I assume that it overdraft also needed, so I take it because it's a growing company. On the other hand, I am taking on the basis that last year 1.6, this year 752, that means it has come down. Even a growing company, the overdraft has come down. That means it's only a part of short-term working capital management idea, not a long-term funding tool. Long-term funding tool. On that basis, I consider it's a short-term. So leave it as short-term. So this is a debt capital, 1.2 billion debt capital. And when you say equity capital 1.646. So when you look at the gearing ratio, I know that how do we calculate? Debt divided by debt plus equity. Debt divided by debt plus equity into 100. So 1244. So you can see that your 1244, which gives you 40%, 43% gearing, 43% gearing. So your gearing of the company is 43%. So 1.2 billion debt, 1.2 billion debt, and your equity is 1.6 billion. So basically we are talking about 43% gearing. That's a low geared company, not high geared company. So this basically gives the idea whether you are dependent to what extent on debt capital. Depend on not what extent to the debt capital. Now going to the unseen discussion. So you can see that debt to equity ratio 10%, debt to equity ratio 10%, and debt to asset ratio 20%. But when you say you buy back, this debt to equity ratio getting worsened. Why? You are going to use debt capital also to buy your shares back. So please be aware that when you go to do the buyback through the borrowing, your equity comes down. When you buy back shares, equity comes down and debt increase. So when the equity is coming down, debt is increasing. So you need to know that your gearing increases. When your gearing increases, financial risk increases. Gearing increases, financial risk increases. On the other hand, you will have finance cost. In your P&L, finance cost increases. Why? You have borrowed money to buy back your own shares. So finance cost goes up, and you are using excess money including short-term investment and cash balances. Since you are using excess money, short-term investment, you will see your investment income or interest income comes down. Financial cost increases, interest income comes down. So these are the possible effect in a buyback, where you will realize that your equity comes down, debt capital increases, and maybe your short-term investment also comes down. Gearing increases, why the equity comes down, debt going up, you will see the gearing is going up. When the gearing going up, financial risk is going up. Maybe other aspects, maybe the examiner have not touched upon. Cost of equity also goes up. When the financial risk goes up in any company, expected return of the shareholder or cost of equity increases. P&L point of view, finance cost increases while you have borrowed money to buy back shares. P&L, finance cost goes up, and interest income comes down. Why interest income comes down? You have your short-term investment utilized for the buyback, so your money invested in the investments comes down, so your investment income comes down. So these are the possible effect. I am not talking from this question only. Any question the buyback, what are possible impact? Maybe resulting effect, earning per share, what happens? Earning per share, you need to understand, if your profits remain to be same, even though you see that finance cost going up, there will be reduction in your profits. But at the same time, your number of shares will come down significantly when you buy back 30%. So earning per share, probably when you buy back, earning per share goes up. Earning per share goes up. So this is basically the buyback situation, and you will see the market value also going up. Market value also going up. Market value, when I say market value per share, market value per share goes up. So these are the possible impact on a normal buyback. Normal buyback. Not specifically to this company. Theoretically, your knowledge has to be when the company buy back its own shares using debt capital, what are possible impact. So earning per share can go up, market value will go up, and number of shares, what happens? Number of shares also comes down. Number of shares comes down. When you buy back, the 30% shareholder shares get cancelled. From register of company point of view, whether any country, register of company, you will see the number of shares of that one shareholder get cancelled. So the number of shares overall comes down. So you will see these are the impact of the buyback. Now coming to the question here. So examiner given you the table where your working capital situation is getting further worsening. Why? Your current ratio 1.18 become 0.78. So even the current ratio is less than 1. Asset ratio 0.74 has become 0.39. That means you are in serious trouble. You can't meet your day-to-day commitments while you are having 39 cents to pay 1 rupee of liability in liquid form assets. So liquid assets are very small, 39 cents for 1 rupee, very small. So you may not be able to manage your working capital day-to-day problem. So this is something seriously you have to consider. Then as I mentioned, the debt equity ratio, what happens? Since your debt capital is going up and equity is coming down, you see that gearing is increasing. Net profit ratio is coming down. As I mentioned because of the finance cost and the interest income reduction. Your profit ratio comes down. These are already the situation analysis already the management account has done. Then going further, adjustment required to the income statement and financial position for valuation purpose. So what are the adjustments they are talking about? The sales will be increased by another 40%. So they are given the number also. Sales will go up by 20% or 40% while maintaining the same GP margin. So GP margin will remain the same. Sales will go up by 40%. Then they say except for the item mentioned, that is sales and GP, all other income and expenses item will remain unchanged. So your 2020 March pre-seen what they are given P&L, that P&L item will remain as it is other than sales and GP ratio changing. Corporate tax 28% effectively. Company has maintained a large short-term investment which has been erroneously classified under trade and other receivable amounting to 1.1 billion. So when you take your pre-seen material, your trade and other receivable has 2.7 billion. But they are trying to say that 2.7 billion, it's Bangladesh currency, includes 1.1 billion short-term investment, which is wrongly classified under that. Ideally, that should have been under short-term investment or cash and short-term investment. So in the balance sheet 2020 March pre-seen, that is page number 20, last page of the pre-seen, cash and short-term deposits is only 1,250. But your 1.1 billion should have been inside that, is already in trade and other receivables. So just keep that in mind, because you are going to use the excess cash and the short-term investment to buy back the shares in addition to the debt capital. So the buyback shares, we said there are two ways of funding. One is your excess money, other one is your borrowing. So excess money is going to be not only 1,250 or 1.2 million, 1.1 billion, which is already in the short, what you call trade and other receivable, which also will be used to buy back the shares. Then company or the management account has concluded. Now the management account analysis is, he has concluded his report with negative sentiments. About the share repurchase based on his analysis above. So see, now these are what he has gone through and basically concludes saying that no point, you should not buy back the shares. Additional information, the Bangladesh company received return of 3% per annum on the short-term investment. Now please understand, you have maybe categorically you have misclassified 1.1 billion short-term investment under receivables, but actually those are short-term investment which had been generating 3% per annum. 3% per annum. Please keep that in mind. Only 3% you are generating. Second, average long-term interest rate has been 7% per annum. That may continue at the same rate. So actually this is the long-term loan interest rate 7%. So you need to understand why they are given this, because they are going to fund your purchase by the debt capital also, 5-year debt capital. Debt capital, what is your cost going to be? So that is what they are trying to say, it's 7% interest. So these are the additional information. Now the question had asked us, as the main shareholder of BD, HCL is interested in the share repurchase proposal despite the negative sentiments made by the management accountant. So management accountant negative sentiments is what is in the table. So the table, what we looked at earlier, the table. So according to management accountant, he shows that all your liquidity point of view, working capital management point of view, it's the buyback will result in a negative situation. You will get into further working capital problem. I think earlier also you had slight a problem. It's going to get worsened when you buy back the shares. Second, he is talking your gearing will increase. That also he has shown. And net profit ratio also comes down. So according to the management accountant, 3 negatives. One is on the liquidity front, other one is from the gearing front, third one is from the profitability front. So all 3 is negative. So no point in company buy back its shares. Basically you don't do that. Now we come to the question, advise the chairman of HCL with your independent viewpoint on the proposal if 30% shares are going to be repurchased by the company. Your opinion should be supported with an income statement, financial position analysis, valuation based calculation, qualitative factor. 15 marks. According to, at this point I need to make a note to say, the examiner comments basically have said that this part, like most of the people have not answered. And even people who have answered have got almost say 2 marks only. So 15 marks question, last part. So what I believe is, one is a time problem, right? You might not be able to do your questions within the 3-hour paper, or time consuming because it's a lengthy questions. So you might take more time to answer the question. But please make sure that you attempt almost all the questions, all sub parts. Maybe you don't complete the entire part, but at least you try to great extent to get some marks on that question. Because you losing 15 marks, you don't attempt the 15 marks in a 100 marks question, it's going to be a detrimental, because 15 marks is a big number. And even though we say 50 marks is the pass marks, to get the 50 marks you need to attempt 100 marks questions. You cannot say I attempted 75 marks questions and I will get 50 marks, which is very, very unlikely. It's very, very unlikely. So you need to attempt 100 marks question. So again I am sure like you would have a problem with your time. So that is where you need to manage your time. I am repeatedly telling these people, students who have been doing, right, manage your time. You need to practice many practice questions, so that you know that within what time you can do one part or one area. And if it is 3-hour paper, I don't need to repeat this. You have to understand, you need to make sure your time is allocated among each and every mark. If you take 50 marks is for the question 1 and 2, your half of the time of the paper will be allocated for the first 2 questions. Second, 50% of the marks or the time will be spent for the case study. Case studies generally takes a lot of time. Why? Simply because you need to read the pre-scene also in the exam hall to capture the certain things. That's why when I started this part also I said you have page number 6, you have something about Bangladesh investment, and page this you have, pre-scene you have. So why I am telling this is what you are going to do in the exam hall also. So it takes a lot of time. So by doing your pre-scene analysis before the exam properly, it will help you a lot in the exam hall, because you can quickly go through, you can remember something is there. They have talked about it. So you can just capture that information. In addition, in the exam hall, your time management is very, very important. Okay, there are people who has not had time and would have missed it. Some people don't have understood what the examiner is asking. It's about a buyback transaction. True that it's a 15 marks question, but it's about a buyback transaction. And the examiner has given you some support. What is the support? In the bracket he has given your opinion because he has not just asked you what is opinion. If that is the case, you don't know where to start, where to end, what kind of things to be looked at. But the examiner knows that you may have that problem, so they are supporting by saying your opinion should be supported with an income statement. So you need to prepare a adjusted income statement. 2020 March income statement in the pre-scene. So you need to do another income statement for the same period, not same period, the future period. You are adjusting with the adjustment what they mentioned. Then the financial position analysis. You have to look at the financial position analysis. Then the valuation based question or the valuation based calculation and the qualitative factor So these all, there are 4 key parts, right? 4 key parts for the 15 marks. So if you can try much as possible to structure these items, you get some marks. You can get some marks. I am sure even a qualitative factor, you can just think, what are qualitative factor? If you are buying back, one Sri Lankan company, we are advising Sri Lankan company. Sri Lankan company owns 35% in Bangladesh company. So we can talk about Sri Lankan company ownership percentage can be increased. This is something Sri Lankan company would be looking for. Why? You have 35% investment and which is generating 22% return. So very good investment, very good return. So might as well you increase your ownership. So there is a one bigger advantage. You see, you are able to increase the ownership in that country. And you want to increase anyway expansion into different markets. So this is a good opportunity. That is one of the qualitative factors. Second, you would see that when you say you buy back the shares, you become a kind of major shareholder. I just showed you your 35% ownership become 50% ownership. So it's almost you are the controlling shareholder. So there is very good advantage for doing this buyback transaction. So you should push to go do that transaction. And it's a profitable company. Very simple thing is it's a profitable company. If it's a loss making or struggling company, don't touch it. It's a profitable company. The other qualitative factors, okay, this company has certain concerns. What are certain concerns? Working capital management issue. As you looked at the ratios, you have working capital management issue. So you need to address that problem. That doesn't mean that you can't run the company. You need to find out where your working capital management issues are. So you need to look at and analyze, and much as possible, you would be able to concentrate and solve the working capital management problem. So you might see that working capital management issue is arising due to you have extended credit period or you have excess inventory, right? You are overcapitalized and maybe your creditors are not giving enough terms, good terms to you. So those things you need to look at it, and one by one you have to push it to negotiate. So if you become the major shareholder, 50% ownership, you definitely have to do that to solve that problem. But that is only one issue to be sorted out. It's not a bigger issue for you because you can understand that company has a solid business and the turnover is going up and profits are there. So you will be able to make money. Okay. Now we look at the answer. Firstly, we look at the income statement. Of this company, revised income statement. So income statement, revised or adjusted, you can call it, revised or adjusted income statement. If you take the without repurchase of shares, you can see that sales, your pre-scene, if you look at your pre-scene, your sales is 5.9 billion. It's in Taka currency, TK. In 2020, your sales is 5.9 billion. So what the examiner says, your sales will go up by 40%. So your 5.9 billion will go by 40%. 40% will be increased. So 5.9 will become 8.375. 8375016. This is the sales going to be, which is 40% increase. They are given that information. They are expecting that increase. Then your operating profit, as you know that since the sales are going up, your GP margin remains to be the same. So if you take the sales is 8.375 on that 40% GP margin, which is 3,350. So your GP is going to be 3,350. GP is going to be 3,350. From the 3,350, you have to reduce all your overheads. Because you have to calculate operating profit from your GP 3,350, you reduce your overheads. So what they are saying, your other items will remain the same. So you can take the same thing in the P&L. That gives you 1,348 million, 1,348,169. So what you have done, from the GP, you reduce the admin and selling expenses in the pre-seen material P&L, admin and selling expenses in the P&L, which is 994 million and 1,022 million. So you reduce those expenses and add other operating income, which is very small, 15 million. So when you get the operating profit, it is 1,348. From that you minus your interest expenses, which is in your P&L. Interest expense is going to be 456, 250 interest expense, and your interest income or the finance income 478,027. Now this is without repurchase. Without repurchasing, only the sales and GP we are changing. Why? The examiner said the sales will go up by 40% and you will have operating, or the GP margin will be remain as it is. So on that basis your GP is going to be this much, same GP margin like earlier, that is 40%. Operating profit will be 1.3, all the expenses remain the same, and interest expenses and interest income are the same. Then your profit before tax. 1,369,946. 1,369,946. From that you minus the income tax. That is 28%. They have said 28%. So 28% income tax. You minus 383,585. That gives you profit after tax. 986,361. So profit after tax will be 986,361 after the sales increase. Still we have not done the repurchase. Only the sales increase benefits to 986, because pre-seen your profit was 297 million. Due to the sales increase by 40%, your profit goes to 996 million. So this is basically the without repurchasing. Now then we know there are adjustments. You might see your suggested answer so that I can explain faster. So suggested answer, you can look at it. When you say you are going to with the repurchase, what's going to happen? Same turnover, same operating profit. Only thing, interest expense will increase. Interest income will come down. As I mentioned, the company is going to buy back its shares. By using the excess investments or excess money, and they are going to borrow money. So there are two ways they are funding. One is excess money they are going to use. Second one, they are going to use the borrowing. So both will have an impact on your adjustments. So we will come to that. So your operating profit and sales will be the same. Interest and income will have an adjustment. In order to do that, we need to first understand how they are valuing. You need to find out the valuation of the company. So can you please look at this suggested answer, valuation of the company, table 4. You can look at the table 4. So your EBITDA, which is table 4, you have two columns. One is without the repurchase, one is with the repurchase. So we will first look at the without repurchase, because you have to buy back the share without repurchasing. That's basically the valuation of company. EBITDA 2.2 billion. How do you get 2.2 billion? Your operating profit is 1.3 billion. 1.3 billion. This is your EBIT. But they talk about, under the unseen question, they talk about you will be valuing the company based on 6 times of EBITDA. 6 times of EBITDA. So EBIT, and you have to consider depreciation amortization. Depreciation amortization in the pre-scene. Page number 19 of the pre-scene. Page number 19 of the pre-scene. They say depreciation amortization included in the income statement 856 million. 856 million. So your 1348 plus 856, that gives you 2204. 2204. Your 2204 EBITDA calculated. This is the EBIT. This is the EBIT. EBIT plus the depreciation amortization, which is in pre-scene. Now see, that's a issue you will have. You are trying with your unseen material, but the one information you have to go to the pre-scene material. So you need to be very fast in doing that, otherwise you are losing some marks, and you may ignore this adjustment also. So depreciation amortization 856, when you add it, 2.2 billion, which is basically your base to calculate your value. And they say that the multiplication will be 6 times. 6 times. On that basis, market value 13.2 billion. 13.2 billion. From that, 13.2 billion, from that is market value total capital. Market value total capital. EBITDA into 6 times will give you market value total capital, that is debt and equity both together. Debt and equity both together. So you minus debt capital. You minus debt capital. So debt capital, as I mentioned earlier, we are only considering interest bearing borrowing, short term and long term. Interest bearing borrowing, short term and long term. When you add that short term and long term interest bearing borrowing, we earlier also calculated, it comes to 1.2 billion. 1.2 billion. So you have the, under pre-scene, again pre-scene, page number 20, interest bearing loans and borrowing under non-current liability 369 million. Current liability, interest bearing borrowing 875 million. So almost 1.2 billion. So that is the table number 4 in the suggested answer. They are deducting from your equity plus debt value, you are minusing the debt value 1.2 billion. Then since your basis of valuation EBITDA basis, you need to understand you got the enterprise value. You got the enterprise value. So you need to add back your excess cash. Add back your excess cash. On that basis, you are getting 13 billion is your market value of equity. Market value of equity. So your market value of equity 13 billion. 13 billion. Now we go to the table number 1. That table number 1, you can see that total number of shares of Bangladesh company 75,000. You might wonder how they calculated, because they have given you in the page number 20 pre-scene your balance sheet. Balance sheet, you have stated capital in Taka currency or the Bangladesh currency 750,000. 750 million. Yeah, 750 million is your total number of share, total number of value of stated capital. 750 million. And if you take the pre-scene, page number 9 of pre-scene, they say the Bangladesh company's ordinary shares are issued at TK 10 rupee per share. So nominal value is 10 Taka per share. So 10 Taka per share, you are talking about in the balance sheet and the pre-scene, page number 20, 750 million. That means 75 million shares. 75 million shares. That is what table 1 says. Your number of shares 75 million. So it's a 10 rupee share, so 75 million shares you have. 75 million shares, and we are going to buy back what percentage? 30%. 30%. One of the major shareholder who wants 30% wants to get out. So you are going to buy back 30% shares. 30% shares will be 75,000 into 30%, which is 22,500 shares. 22,500 shares. Total market value of the equity. Total market value equity. What we looked at in page table 4, 13 billion. 13 billion. The examiner given that int also in the unseen material. Unseen material, the value what they have calculated is 13.2 billion. So they have just given you some idea that your value of the company is 13 billion or 13.2 billion. So you take the 13 billion into 30%, which comes to 3.9 billion, 3.9 billion. Then you divide the value by number of shares, 22,500, you get price per share 174 rupees per share. So that basically gives you the how much is your value of the target company, value of the target company, or sorry, value of the buyback, value of buyback. So your repurchasing value is going to be 3,924,663. 3,924,663. This is your buyback value, buyback value. How we are going to use, how we are going to do this buyback? This is the value of the purchase. You are going to use the excess cash for the investment, excess short-term investment or cash. Then you use the debt capital. You use the debt capital. So you need to find out the debt capital, how much you are going to use. From the purchase value, repurchase value 3.9 billion, excess short-term investment you have to use, which is 1 billion, 1.1 billion they have said. So 1,250. This is your short-term investment plus the excess cash, 1.101250. When you minus that, you get your debt capital. So you can look at table 3. Table 3 basically talks about how much your borrowing going to be, how much your borrowing going to be. So that is going to be 2,823, 413. So debt capital going to be 2.8 billion, 2.8 billion. So you are using 2.8 billion debt capital and your excess investments or short-term investment cash 1.1 billion. Total of 3.8 billion is used to buy back the shares. So this is basically buyback transaction, how you are going to fund. So 2.8 billion is your debt capital. If the 2.8 is the debt you are going to borrow money, this borrowing will be at the rate of 7%. At the rate of 7%. So you have to find out how much my finance cost is going to be if I say, if I am going to borrow 2.8 billion at the rate of 7%. So as I mentioned, your adjustment due to the buyback, your interest expense will be increasing. Interest expense will be increasing by 7% of your 2.2 billion. 2.8 billion. So your 2.8 billion at the rate of 7%, your interest cost is 197,639. You can look at it in the suggested answer. 197,639 is your finance cost. So additional finance cost you are incurring because you are using debt capital to buy. Further, you are using your excess investment which was there in investment, short-term investment. You are utilizing that money also to buy back, which was earning at the rate of how much? 3%. So you calculate your 3% investment income, roughly 33 million. 33 million will be lost. You won't be able to earn this 33 million because your investment, short-term investment monies are going to be used to buy back the shares. So there is an impact of this also. So these are two main adjustments because of buyback. One is increase in your finance cost, other one is reduction in your investment income. Those two are in table 2, you can look at it. Then you can look at the another column, that is basically with the repurchase. What is your P&L? So please look at it. Taxation, there is a deriving impact. When you say your profits are changing, your tax will change. So that is also shown there. So accordingly, your profit will be 820,301. So this profit will be 820,301. So your profit is coming down. Due to the buyback. So management accountant net profit ratio came down. Obviously it will come down because of this impact. Your finance cost increase and your investment income reducing. So if you really look at on absolute term, your profit is coming down. But that doesn't mean that you are going to lose. Why? Your number of shares are also going to go down. Earlier we had number of shares of 75,000. When you buy back, we buy back 22,500. So balance shares 52,500. So please understand, before the buyback you had 25,000. You are buying back 22,500. So your net amount after buyback, your total number of shares 52,500. 52,500. So we have to understand that even though profits, overall profits comes down, your number of shares of the company also comes down. Now you look at the earning per share. Table number 2, please look at your earning per share. When you look at your table, earning per share, how much? 13.2 earning per share now become 15.62. So even though profit has come down, earning per share increased. Why? Your number of shares has come down. So it's not a bad thing for the shareholders because they are benefiting. The existing shareholders will benefit. Why? Your earning per share increases. Even though overall profit comes down, but still my earning per share increases. So 15.62 from 13.2. So that's basically the income statement, and we looked at the other impact. Then coming back to the valuation. Valuation without repurchase, table number 4. Without repurchase, we looked at the market value of equity. Same thing we can calculate it with the repurchase, or once you do the repurchase, what is your valuation? Say claim 2.2 billion EBITDA, market value is at 6 times, that is equity plus debt, 13.2 billion. Only thing, debt capital have increased now because of the funding the repurchase by 2.8 billion. So when you had earlier 1.2 billion debt capital, now you have borrowed 2.8 to buy back the shares. So almost 4 billion you have debt capital. So when you minus that, you get 9.1. There is no excess cash in this story, excess cash. So you are talking about, you have to understand that excess cash is not there. So your market value is going to be 9.1 billion. Okay, so that basically gives you the valuation after buying back. So we can now look at after table 4, the return on equity calculation. They are compared both without repurchase, with the repurchase. Without repurchase, 986 million, what we looked at earlier, 986 million. With repurchase, 820 million. So you are saying that profits absolute amount has come down from 986 to 820 million, but your market value of equity earlier 13 billion, that is without repurchase, with repurchase 9.1 billion. So it looks like your market value equity has come down. Why it has come down? Because your number of shares, shareholders' money had been returned back. So obviously your equity capital comes down. So equity capital market value is 9.1 compared to 13 billion. So when you compute the return on equity, 7.5 to 9%. 7.5 to 9%. So as a shareholder, existing shareholder, you are benefited while your return on equity is going up, your earning per share is going up. So you will understand that because of that I am benefiting. Then they have given you the gearing. Obviously gearing will go up, as you looked at earlier. You can just look at the table. Gearing goes up. So they have given you the benefit to the existing shareholder. Return, that is the profit absolute amount. They have shown profit is coming down. Equity also coming down, overall equity. But return on equity, 7.5 become 8.96. 7.5 become 8.96. That is, return on equity is increasing. EPS 13.2 to 15.6. It is also increasing. So they have calculated PE ratio based on the earnings and the market value. That they are saying it's reducing. This leverage or the buyback, they have talked about the working capital management concerns, what we talked about earlier. And the other qualitative factors, they are talking about non-availability of other investments, effective ownership increases, shareholder wealth changes, management impact, all that they are talking. So overall point of view, when you look at this buyback, the shareholders are going to benefit, existing shareholders are going to benefit. Why? Your earning per share is increasing, that is per share. Second, your market value per share is increasing, and your return on equity is increasing, and gearing is increasing. Gearing increase is not that always great, like gearing increase have a plus and minus both, but as a profitable company, even if your gearing increases, still it's okay because you can manage with your profits, because you have enough profits to pay your finance costs. I think that here we looked at the finance cost goes up because of your borrowing. still you have 820 million profit, 820 million profit. So if you are having 820 million profit, that's a good money, good money. And I think the Sri Lankan company will be the 50% owner after the buyback. So you get 400 million return, 400 million return. So your 400 million return is for your whatever the investment value. So you are benefited, So you need to understand that the investment for the Sri Lankan rupee investment, it is in page number 16 of pre-scene, 984 million. Sri Lankan company has invested 984 million. So 984 million investment you are going to generate, earlier we were generating 630 million profit after tax, the Bangladesh company, 630 million rupee wise I am talking, 630 million profit. So if you take the conversion rate, 630 divided by 297, 2.12, it's 2.12 the exchange rate between Sri Lanka, Bangladesh currency and Sri Lanka, 2.12. So on that basis, if you take this 820 million, this is your profit after tax. So 820 into 2.1, that gives to 1.7 billion. That again 0.5, you are talking about 861 million. So I am just trying to tell you that it's a very good opportunity for Sri Lankan company, the HCL, to increase their returns, increase their market value for a foreign investment. So it's anyway a good opportunity for them to do. But to be honest, that company goes through some working capital concerns. You need to address that issue. You need to address that benefit or the issue, and you manage that working capital problem and concentrate where the problems are. As I mentioned to you, it can be your data holding period is higher because you are increasing sales faster. So when you go to do the sales faster, you might give extra credit to the customer. So that can be one issue. And you might have excess inventory. You might see that you want to increase your inventory. So if you are holding inventory unnecessarily, you need to reduce that. More than anything, your creditors, you need to speak to your creditors and reduce your credit period. So you need to see whether you are getting into over trading. So you need to look at that area also and solve the problem. Somehow you need to solve the problem so that you benefit. You benefit as an organization. So the Sri Lankan company also will derive that benefit. From the return, market value point of view, it's a good opportunity for the buyback. So that entire company benefit out of it. Okay. So that's basically the last part of this question. As I mentioned to you, the examiner comment on the this area, question 3, if you look at, I just quickly go through some of the comments, starting from question number 3, A part, I think question number 3, A part, the examiner comment is that limitations of market-based valuation technique, discuss the market value-based valuation technique, limitation, candidates provide a fair answer. So that means students have answered that part very good. B1, Roman number or the B part of the question, if you look at the so A part, limitations based on that, not the B part, A part, limitations everybody has answered. But when you look at the A part, the valuation calculation, some of the issues students have not attempted properly was, information was given for 2 years, students worked out the individual year calculation and arrived at a simple average for each parameter such as PE ratio and EV. So actually whenever you are given EBITDA information or earning per share information for a couple of years, generally we take the latest year. But if you see that there is a volatility in business environment, when you are given 2 years, better to take the 2 years and average it. That's what we did in the answer. So that was not done by the exam students. Then some of the people could not calculate the EBITDA. That is EBITDA mean what? operating profit plus depreciation, operating profit plus depreciation. So students have not done that properly. Then the debt and cash values have not been considered in arriving at the value of equity. Actually the EBITDA valuation gives you the enterprise value. EBITDA valuation gives you enterprise value, that is equity plus debt. So you need to make the adjustment to get the equity value. You need to make the adjustment for equity value, that was not considered. So you need to understand there are two adjustments from the enterprise value to the equity market value. Two adjustments you would have considered. One is your debt capital has to be adjusted and the cash, excess cash has to be adjusted. Then market to market value, calculate the market value per equity share. Students have not given the ranges. Actually you have to give a range of your market value. Always remember, we learned there are valuation methods, but when you calculate using different methods of valuation, you get different value. So when you are going to suggest a value to say do something, that value needs to be a range. You say 23 to 33, 32 to 5, something has to be mentioned based on your value, because you will see one method of valuation will give you 20, PE method will give 1, EBITDA basis will give 30, maybe the free cash flow will 40. So you need to give a range of value. It's not a one value. Never give a one value, say this is the value of the company. Okay, that is something the examiner has said that people or students have not answered properly. Then B1, Roman number, question number B1. But they are saying that most of the students have failed to discuss very important limitation, that operating profit, because that question was based on the operating profitability is considered without calculating the interest impact or the finance cost impact, tax impact and return to shareholder. So without looking at that, you are basically evaluating the segment performance and deciding on it. And you might looking at the operating profit and say operating very good, continue the business, you can survive sustainably. But when you look at it with your finance cost, tax impact, return of the shareholder expectation, when you look at it, it's not worth to run the company or run the business segment. So that's basically not considered by the students. Then students have not calculated the EBIT or the operating profit ratio, right? Other financial informations are in your pre-scene, but people have not looked at that. No one has showed the calculation of how to calculate your EBIT divided by your sales, that is operating profit ratio. Then a question number 3, B part, Roman number 2. There are 4 parameters they are talking about. So the students have not compared this parameter properly. That means you have to compare the return on equity with your cost of equity. Return on equity and cost of equity comparison. Otherwise WACC and your return on investment. Return on investment WACC. So there are two parameters you have to compare and see how you are doing business, each segment. This table comparison has not been done. If you look at the suggested answer, there is a table, 2 tables given. So similarly you should compare this segment by segment. And very important, return on investment is not given in the question straight away. So you have to calculate return on investment. That is majority of people are not considered. So these are some of the weaknesses have been looked at in your 3 part or B part, Roman number 1. And Roman number 2, some of the strategies students should have mentioned have not been clearly mentioned, how to solve the segment problem. Question number 3C, many students have identified that different segment cost of equity is different. Why? Your business risk, that is systematic risk, is different. So that students have answered, that's good, everybody has a good knowledge about it. So that is something they have mentioned. D part, that's what last part we discussed now. Performance was very poor for part D of the question. Students could earn only a maximum of 2 marks from the 15 marks. So students can earn only 2 marks out of 15. Some commented that working capital position is further weakening. So that is true. So they have mentioned that, but there are other areas whatever we have discussed has not been looked at. In general, the conclusion of this whole question, in general, the examiner comment, this is examiner comment. In general, students are advised to pay proper attention to the details of the paper. Each and every line counts. There are some information. Details of the paper, and focus on the format of building the answer, because there are many tables, many calculations, many paragraphs you write. So you need to structure in your mind how I am going to do this. You might have a working paper means that calculational purposes, and you need to finally present something to the examiner. This is my answer. So you need to show that properly. You should show properly. You can't be writing starting from something and just workings. You need to make sure that I picture or visualize my answer going to be like this. So I can have any number of pages, I can write it, I can do that, but you would refer to your final answering. So I know that definitely the exam point of view, exam hall, you are under pressure, your timing is limited. So you need to make sure that you have, end of the day, examiner is not going to search for things. You should have some reference to how you are calculated, how you are basically answering. And when you are saying conclude or you are asked to give an opinion, please make sure that you are writing that opinion somewhere properly. You need to mention that is my final opinion. Otherwise, the examiner won't know what you are trying to tell ultimately. In this question is that share buyback is agreed, it has to be done. But you need to consider about the working capital management issues. Otherwise, it's good. Overall, that's my answer. Same thing has to be mentioned. And then they say that students are advised to manage time effectively and attempt to answer all parts of the question 3. That's what I earlier mentioned also, all parts, because sometimes that 15 marks question, since you didn't have time, you are not attempting. But when you really look at the 15 marks, some of the parts you would have got easily. This P&L is nothing difficult. P&L is nothing difficult. You could have scored 2-3 marks on this. And calculating how much is your funding, debt funding for your buyback. Total value is this is your excess money, this is your debt capital. So this is not something difficult. So when you say your gearing calculation or you are calculating the market value calculation, some of the things you could have got some marks. You may not get 15 marks, at least 6-7 marks easily you would have got it. So please make sure that your time is reasonably allocated among the paper questions. Right? Don't spend more time in one part of the question, but unfortunately you are using the scoreable marks somewhere else which is lying, which you have not seen it even, where you have not read that last part. So please manage your time effectively so that you get benefit out of it, and very importantly, go back to your study pack. Go back to study pack, because study pack has a lot of learning for you to read and understand. So each and every area whatever we have gone through, you can go through that to understand the study pack. Wherever you see that you are weak, you should be able to make use of that study pack and your class notes wherever you are gone. Make sure that you have got it. The other important thing, you need to practice. You need to practice some of the questions and see whether your understanding is correct. So do you feel uncomfortable in explanations or knowledge, then you share or you learn about it with your friends or anybody and your lecturer. You can speak to them and find out, so that they will help you to clarify some of the area. You can't memorize things, you have to understand logically. For you to write paragraphs and all, you need to understand. Okay, so study pack is must, and these question papers whatever we have done, please go through again and again and see where you have gone wrong, what are your difficulty in understanding, and make sure that you are clear on those. Okay, so that's basically this paper. So thank you.